It's time to talk about an interesting topic, and that's why services businesses can't raise venture capital. If you're raising venture capital, then this video is for you. Stay tuned. Now, you may be thinking that you're a technology startup and this entire topic doesn't really apply to you. Think again. There is a mistake that many startups make, and that's using services language in some shape or form in their pitch decks and their verbal pitches that is critical. There is a way to handle this, and we'll talk about it. Now, the obvious case for services businesses not being able to raise venture capital is pure play services businesses. These could include businesses like professional services, lawyers, accountants, consultants like myself, architects, includes IT services like software development companies, data analytics companies, healthcare services, doctors, dentists, physical therapists, hospitality services, restaurants, hotels, and the list goes on and goes on and on and on. You can go on Google and find out whether you're a services business just by Googling what you do. Now, I think that services businesses are a great way to get started, learning about a space that may be new to you, and then ultimately productizing your services or developing fully fledged products, but it's just not viable as an opportunity for raising venture capital. You will not be able to do so because venture capital investors are looking for technologies that can scale quickly. Just think, if you were to go from having, let's say, 50 customers today to 1,000 tomorrow, could you handle that type of increase rapidly? Or could you rapidly go into new markets? You probably couldn't. You would probably need to hire more people. It would probably take you a long time. And that's just not the right thing for a startup that wants to become a unicorn, that wants to become a $1 billion plus business. And I'm saying this as someone who is building a service or has built a services business too. So I wouldn't be able to raise venture capital either at this point. I would need to change my business. Now, here is the fun part that I'm observing with many startups that I speak to. It's actually a surprising percentage, and that's why I said in the beginning, just because you're a technology startup doesn't really mean that you shouldn't listen to this video, because what happens is that many startups in their deck somehow use services language. They may be offering services in some part of their business. Maybe it's, to get customers in the door. Maybe it's training customers, offering courses, offering events, whatever it is. Anything that's a service doesn't fly with investors. As a matter of fact, I recently, for instance, spoke with a company that's launching events, physical events, in order to have people come together as a community. And although they have a web app and a mobile app, it's events, right? You couldn't go from the number of events that you have today to 10 times that number overnight, because you would have to have event organizers, for instance. This is also why it's so much harder for hardware businesses to raise capital. Even if you are a technology business that has a hardware component, it will be exponentially harder for you to raise venture capital, because investors will immediately think about, holy moly, it is going to be hard to scale this. You have to figure out your supply chain. You will probably have a bottleneck in your supply chain. Your unit economics will probably suffer because hardware is expensive and the marginal cost of additional goods is just keeping going. It just goes up and up, which is not happening in software. You will have returns. You will have malfunctions. And ultimately, that's just not as interesting as a business. And so hardware is another example of where it happens, but also technology, pure play technology businesses do sometimes mention that they do services in some shape or form, and it doesn't really help. My general advice here is, especially for instance, if you're an enterprise SaaS, right? It can be impossible to get the foot in the door with large enterprises if you don't offer some type of consulting, change management, digital transformation, and personally also just training with regard to the technology that you're offering. And that's fine. You wouldn't want to call that services if you're an enterprise SaaS. You would call it something like onboarding. Onboarding is, I think, generally, as far as I can say, and as far as I think as a former investor, is acceptable for startups. You can have an onboarding flow. It's ideally as short as possible, as lean as possible, because again, it will mean your ability. It will be a roadblock on your ability to scale. Another example here could be that you may need to offer customizations. This is something you generally want to get away from as much as possible, if there is any way to do so. And if you are having to do it, you don't want to mention it in your pitch deck. If an investor asks, you definitely want to be talking about it and be transparent, never lie, etc., etc. but you don't need to be saying things that hurt you. And that's the major mistake that I see startups making. In some way, even if they don't really do services or don't mean to say that they're doing services, having it in their pitch decks. Now, if you are a services business that's transitioning to productization, that's transitioning over into becoming a product-based company, or maybe it still runs the services but has developed some kind of technology product that it's trying to commercialize independently, it makes sense to create a new legal entity, to infuse that with capital, to infuse that with talents, that talent that is, one, appropriately incentivized in terms of ownership of that business and fully committed to that. That works. And again, as I said in the beginning, I think it's a great strategy to go, instead of just right to technology, start with services, learn what the needs of your buyers are, of your audience is, and then develop a solution for that they will actually like and appreciate and buy. Too many startups are building stuff that no one wants, and offering services in the beginning can be a fix for that. That's why I think if you do it, just make sure, and you want to raise venture capital, you may not have to because services generate cash flow that could float the technology side of the business. But if you do want it, then spin out a new company or shut down your services business, spin up a new legal entity, and that should position you for success in raising venture capital. An interesting case study here is actually AngelList. They've gone through a lot of pivots over the years, as far as I think, as far as I know, and the name implies they started as a list where you would, as a startup, be able to connect with angels. Then they went into the recruiting space, and most recently, I think they have rebranded these two types of businesses into other platforms or are called separately, and they mostly focus on fund management. And by fund management, I mean fund management for venture capital investors, special purpose vehicles, and stuff like that. Actually, the CEO of AngelList was recently on the Acquired podcast, which I can highly recommend. This specific podcast, but also the Acquired podcast overall. And what he says and what he walked through is how they started being almost a very manual services-based business, because fund management is manual work. You have to file all kinds of documents on an annual whatever basis. And they have now automated their processes to such an extent that they need a minimal number of employees relative to the number of funds that they can manage. It would be impossible for any other fund to do this individually at this scale without having hundreds of employees. AngelList has figured out the automations. And I think at that point, you are a true startup again, because that's nothing else than a product supported by some employees, but it's scalable. That's the key point, right? Investors want to invest in scalable businesses. Make sure that that's what you do. If you are a services business, use the cash flows that you generate in order to build technology, productize, and ultimately potentially consider spinning off or creating a new legal entity in order to maximize the chances of raising capital. Again, if that's what you want to do. All right, that's it from my side. If you enjoyed this video, consider leaving a comment. If you enjoyed it, leave a thumbs up. If you have a question, leave a comment below. I'll get back to you. And if you enjoyed the type of content that I generally publish, make sure to subscribe to the channel. It means a lot to me as a content creator. I appreciate it. Have a great day and talk soon. Bye-bye.